Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Equity markets have been on a tear lately, notwithstanding a fair bit of fluctuation. The broader story is one of markets trading at or close to record levels. Locally, the S&P ASX 200 hit a new high last week. European and US markets in particular have done pretty well. Also, how far can they go? Remember, this is general information only, and you should seek professional advice before making investment decisions. Dr. Shane Oliver is AMP's Chief Economist and Head of Investment Strategy. Shane, welcome back to Fear and Greed.
Thank you, Sean. Great to be here.
So let's start with the macro outlook before we get to markets. Can we avoid a global recession?
Look, I think we can, but it will be a close call. It's hard to believe that you can raise interest rates as much as we have over the last 2 years globally and in Australia and not have a major economic impact from that. But so far, so good. We have seen inflation come down and we have seen economic conditions in key parts of the world remain relatively resilient, which suggests that maybe we'll be able to get by with the so-called soft landing. And that's partly why share markets have been celebrating lately. But I would have to say it's a close call. Lots of things could still go wrong here. And some would say that the signal from inverted yield curves, the decline in leading economic indicators and so on is still warning that recession risk is still quite high.
And that means lower rates potentially might have. I mean, you've been one who has suggested that we perhaps need lower rates sooner than others have thought. And that is on the back of this fear about things going too far. Is that right?
That's right. Our concern right along has been that central banks need to be cautious in raising rates, particularly in countries like Australia where household debt levels are so high. And of course, so far, so good. Economies have not collapsed. They've slowed down generally, although the UK, I think, has gone into recession and Japan and Europe are close to it. But other parts of the world have sort of hung in there, including Australia. There's been a bunch of things helping out there. But there's always a risk here that we're living on borrowed time. Interest payments on mortgages in Australia have gone through the roof. And obviously, the higher interest rates are left at these sorts of levels, the longer they're left at these sorts of levels, the greater the risk that some of the supports from the last year, such as the running down of savings buffers built up through the pandemic, the desire to get out there and spend, and also the fixed rate protection that many home borrowers had, many of those supports will start to run off. So that's why I think central banks have to be cautious here, and we think ultimately the Reserve Bank should be cutting sooner rather than later.
Okay, so let's shift this to markets and particularly equities. You talked about Japan being in recession, yet its share market is at a record level and hasn't been at these levels for 35 years or so. Australia, we had a great slowdown in growth at the end of last year, 0.2% for that December quarter, yet we are at a new high. Wall Street's at a new high. Have the markets gone too far?
Well, that's obviously a big question at present. I think the fact that markets go to record levels doesn't necessarily prove anything. The history over time has been that share markets trend higher with economic conditions. So economic activity around the world is at a record high. So it's logical that share markets are too. But obviously, when you look at valuations, they're not as attractive as they once were. In the US, a lot of the strength has been concentrated in tech stocks, AI related in particular. Very high price to earnings multiples. I don't think anywhere near as extreme as it was back in the year 2000, but nevertheless, that risk is there. And likewise, we've got higher bond yields than we used to have. So when you look at the gap between, say, the earnings yield that shares offer, whether it's in Australia or the US, and bond yields, which some would see as a proxy for the risk premium that shares offer over bonds, that risk premium has collapsed relative to where it was for much of the post-GFC period. And so with shares offering a lesser risk premium, there is a risk that something could go wrong. So you've got a situation now where shares are a little bit overvalued. I wouldn't say dramatically so, but a little bit overvalued. They're technically overbought, having run so far, so fast. And we're now moving into a situation where there's a lot of euphoria around. I wouldn't quite say it's bubble-like conditions, but investors are feeling a lot more confident. When you move into a situation like that, you'd have to say there is a risk of corrections at least, or more volatility out there. But trying to time any of that is always going to be very difficult. Some people say it's a bit like 1995. Interest rates will soon come down, ushering in a 5-year period of strength. Others say, well, no, it's not. It's closer to 1999. We're getting close to the top. So that's why investors need to play it a little bit more cautiously, given that we have seen these strong gains. The bottom line, though, is that we are likely to see lower interest rates this year, and that I think will provide an underpinning for markets, but we could see a lot of volatility along the way.
There's a lot in what you just said there, Shane, and I want to kind of bring it to asset allocation at this point then, because that whole idea that the risk-free rate or near risk-free rate that a bond gives you is so much higher than what it was, therefore you need an extra increment, a decent extra increment to invest in something that's more risky, such as equities. In terms of asset allocation, is it more in March 2024? Is it more about going back to a traditional type of portfolio? And when I say traditional, I'm probably talking about 20 years ago rather than 5 years ago. Is that kind of where we're up to in terms of asset allocation?
Well, sort of. I think it's a time to have lots of diversification in there. Bonds do provide you with that diversification. They didn't, mind you, in 2022, because 2022 was an inflationary shock. But if you go back to the time of the pandemic, that slump that we saw in shares in 2020, that's where your 5-year story comes into it, that slump saw bonds rally. So shares fell 35% or so. You got some protection by having bonds in there. So I think we've returned to something like that with the rise in the bond yields up to around 4.5%. That means that bonds offer you a pretty good starting point. Maybe not as strong as it was when I started my career 40 years ago, but it's still much better than it was a few years ago. And therefore, if we do perchance go into recession and the risk is something you can't ignore, then shares could take a tumble, but at least bonds would rally as well, providing some offset. So there is a case for diversification there. I don't think it's a time to sort of say, well, okay, Bitcoin's running, or gold, we'll shove it all into that, because we also know in recent times anyway, when share markets fell, so too did Bitcoin. So I think it's probably looking at more traditional allocation and looking for bonds as a good diversifier as opposed to other alternatives.
Stay with me, Shane. We'll be back in a minute. I'm speaking to Dr. Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. You just mentioned gold and Bitcoin, and this is a question which I have not been able to answer. Why is gold at an all-time record when Bitcoin's not at an all-time record, but it's certainly high? They kind of, to me, are almost opposites. But am I totally wrong there, Shane?
Bitcoin and gold create a lot of confusion. Bitcoin, I think, is the thing that's thrown the spanner in the works and disrupted everything. When people talk about Bitcoin, many of them go into 2 or 3 camps. There's the evangelists who almost see it as a religious experience and are full of the jargon. And then there's the agnostics who don't really know, might be something in it, but might not, but I'm a bit skeptical. And then, of course, there's the atheists who say it's complete bollocks, stay away. It's just the latest fad, like along there with South Sea bubble tulips and so on. So you got to be a little bit cautious. But what does seem to be happening here with Bitcoin is, like, I find it very hard to value. It doesn't generate rent or earnings or coupon payments that bonds do. So very, very hard to value, very hard to find its use case. But what it does seem to be doing is acting a bit like gold. You know, the crowd in the past who said, well, I'd rather have gold because it can't be confiscated, it can't be debased by central banks printing more money. If I have the gold, you know, I don't have to rely on the banking system, which might go bust and so on. And I don't trust government generally. Those people are now thinking, well, maybe let's go digital and Bitcoin is the way to go. So that's excited a whole group of people. And I think it's taking money away from gold. If we didn't have Bitcoin out there, the gold price would be a hell of a lot higher than it is now, even though it is also at a record level. But at its core, both of these assets are benefiting from anticipation of lower interest rates ahead. They are the most speculative, interest-sensitive assets out there. When you talk about lowering interest rates, that lowers the opportunity cost of buying gold or Bitcoin and supercharges them higher. Bitcoin also benefits from the advent of ETFs that can directly buy Bitcoin, and also the so-called halving, which I think is coming up in the next month or so, which is, I won't go into all the jargon around that, but it doesn't surprise me particularly that these two assets are taken off again. And I think it's just part and parcel of the way they operate. They're incredibly volatile, but you do have to go in with your eyes wide open. And I have a simple rule: if I don't understand something, I don't invest in it. And I must say, I'm still in the skeptical camp regarding Bitcoin.
Okay, so the moral to this story is diversification, is that right?
Like, I think the moral to this story is certainly diversification. Yeah, sure. You know, if you are skeptical of governments and worried that there's going to be some debasement of paper currencies, then yeah, you might want to have a bit of Bitcoin. It also is very trending, momentum. It's on the way up again, so you might make some money in it. But trying to trade that, I think, from a fundamental point of view, is next to impossible. So I think for the average investor out there, yeah, you might want to put a bit of money in it, but I'm not recommending that, certainly. But I think the key here is always focus on assets that provide some sort of income stream, which you can then use to value those assets. So given the uncertainties around, yes, you want to have a bit of equities in there because they could keep going up from here. And longer term, I think they will do well. But you might also want to have some government bonds in there because if things do turn sour, then they will provide you with some protection.
Shane, we haven't spoken for a few months now. You were the person that got me on to Taylor Swift about 3 years ago. Did you go and see her when she was out here?
Well, the good news is that I did. My colleague, Diana Messina, and I were both trying back in July when the tickets were first released, and both failed, me abysmally, because I was fortunately let in, but stuck up my Ticketek password and got turfed out after 10 minutes. So I'd sort of given up. Yes. And then a colleague of ours managed to get us some of the El Cheapo seats for $66 when there was a release about 4 weeks ago. So both of us managed to get there. I took my daughter and she took her brother-in-law. Babysitting issues obviously impacting there, but fantastic event. And
was she good?
I thought it was fantastic. And I'm someone who appreciates pop, and she creates classic pop music with lots of hits over what is now a 17-year career. So it'd be a bit like going to see Paul McCartney in 1980 or something like that. He'd have a lot of material to draw on, just as Taylor now does. So I thought it was well worth the money. Out of interest, $66 is equivalent to about $3.70 in 1964, which is what people would have paid to see the Beatles. So
only you has done that calculation.
I paid Beatles prices to see Taylor Swift in a massive stadium, but I got 3 hours out of it, and I got to see her on a giant screen. But a lot of the time, we didn't get to see the stage because we were off to the side. They were the El Cheapo seats.
Fantastic. Well, you have put me on to Taylor Swift, and my kids were going to put me onto it eventually anyway, but you were the first one there. Shane, thank you very much for talking to Fear and Greed.
My pleasure. Thanks for having me.
That was Dr. Shane Oliver, Chief Economist and Head of Investment Strategy at AMP. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.